Welcome to the Hurst Trading Room. This is our video update for the 4th of February 2013. As always, before we take a look at the markets, please make sure that you have read and understood our disclaimers. In the markets last week, the S&P 500 kept its gradual but consistent move upwards, as you can see, which has been the theme of 2013 so far. For the entire month of January, the S&P 500 rode upwards in a very narrow channel, and of course last week we were standing by to enter into an F category short trading opportunity, and indeed this week we are still standing by to enter into an F category short trading opportunity. So let's quickly have a look at those opportunities. Here on the chart, here was our A category opportunity, and this is based on the preferred analysis, which of course has the 20-week cycle trough in the middle of November and the 40-day cycle trough in the last week of December. So that's 40 days over there, and that's 20 weeks back in November. Take a look at the detailed video about the S&P 500, in which I discuss the alternate analysis that might be playing out in the S&P 500 and how that affects our trading decisions. But there was the A category trading opportunity over there, and here of course was the B and then C, and here was the D category opportunity over there before Christmas, and here was E. And so next is of course the F category trading opportunity, and so we are still standing by to sell in the S&P 500 for an F category short trade. Also in the detailed video about the S&P 500, I speak about the possibility that the 80-day cycle trough, which is expected round about now, as you can see from this nest of lows at the foot of the chart, that's the nest of lows for the 80-day cycle. In other words, we're expecting an 80-day cycle trough to form round about now. I discuss in the detailed video the possibility, although it is a remote possibility, but it is a possibility nonetheless, that the 80-day cycle trough has formed already in the market, and it has formed as a straddled or insignificant trough in the market, which is something that we will often see when the dominant cycle is a long cycle, such as the 20-week cycle or the 40-week cycle. Now, I realize in recording these videos that I am assuming that if you're watching the video that you are also reading the analysis that I put out every weekend. And on Saturday I put out an analysis, a blog post about dominant cycles and about why the 20-week cycle is clearly a dominant cycle in the S&P 500, in fact in the US markets generally at the moment. And so just in case you are not reading that analysis, let me show you how to find it, because I do believe that reading that analysis will certainly help you to make sure that you are doing the right thing in terms of making your trading decisions. So if you simply browse to our website, sentienttrader.com, and then go to the menu item Hurst Trading Room and click on blog, then of course you can see all the posts that we are putting into our blog, and every Saturday I put a post which updates my opinion about what's happening in various markets. And so if you go on read more, then you can see I wrote a post on the 2nd of February all about cycle dominance. So I believe it's really important that you keep an eye on these blog posts, because they do help to inform the analysis, which of course I'm then speaking about in these videos, which I record on a Monday. And if you'd like to receive these blog posts by email, simply enter your email address over there, and you will receive them by email every Saturday, shortly after I make the post available on the website. So that's what's happening in the S&P 500 at the moment, and take a look at the detailed video where I speak a bit more about the whole concept of the dominant cycle and why it's done what it has done over the month of January. It's not an unusual thing to see, whereby the shorter cycles get suppressed by the dominant cycle. That's a very important concept. And so take a look at that detailed video for more detail about that. Let's take a look at the Nasdaq. Now, in the Nasdaq, as you know, recently I have been monitoring and trading the alternate analysis, which could also be playing out in the S&P 500, of course, which is that there was an 18-month cycle trough, which occurred in the middle of November. I put a question mark there because it is an alternate analysis, it's a possibility, and of course that the 80-day cycle trough occurred here on the last day of 2012. So that is an 80-day cycle trough over there. And so that is the analysis that I've been tracking in the Nasdaq. And the Nasdaq has been doing something really very interesting because it has been tracking along, price has been tracking along the FLD for 3 weeks. That's a really long time to see price tracking along the FLD. And I discuss in detail in the detailed video why that has been happening, why that might have been happening, and how in fact we can still identify the correct sequence of trades. Now you will know that in last week's video I discussed the fact that I was in a long C category trading opportunity, and I exited from that trading opportunity last week when I realized the trading opportunity wasn't really going anywhere. There is our A category opportunity, then this is B over here, and here was C. And of course we entered into the long trade, and our initial stop loss was down here. So our full risk exit would have been down here at the 2700 level. I entered a very small trade, you will remember, in the Nasdaq because of the fact that there was some analysis uncertainty, and so I entered a very small risk position, risked a very small percentage of my portfolio, and as I discussed last week, I set a tight stop on that trade, because an important thing to bear in mind with trading using the FLD trading strategy is that cycles, of course, take place over time. And if you've been sitting in a trade, particularly a C category trade, and price is not really going anywhere and it's tracking along that FLD, then there's something wrong. And what was wrong in this particular instance, as I discuss in the detailed video, is that I believe the C category trade lasted for a total of about 2 days. All right, then it was over. And price did reach up to a new peak over here the day after we entered the trade, but the C category trade was over. I think that we've seen a D category interaction and an E category interaction, and that what is going to happen next is an F category short trade in the Nasdaq. So our two closely correlated instruments, the S&P 500 and the Nasdaq, having diverged a little bit in the paths that they were taking, have now converged again, even though I'm tracking different analyses in both instruments. And that is why I like to track these closely correlated instruments, as you know by now, because occasionally you get different analyses, and the different analyses result in very much the same trading decisions. However, I discuss in the detailed video about the Nasdaq how you must be very careful not to jump in at the level of the FLD today, all right, because price has been tracking along the FLD, so you need to be very careful. So I discuss in the detailed video the level at which I would enter into this F category short trade in the Nasdaq, and I also discuss the alternative options that might be playing out in the Nasdaq, as well as a fairly interesting discussion, in my opinion, which has to do with fundamental interaction, because potentially, and if we zoom out on this chart, we can have a look at this. Potentially, there was some fundamental interaction surrounding Christmas and New Year, which might have distorted the cycle picture slightly. Not badly, but it might have caused a bit of distortion. So if you're interested in fundamental interaction and how it affects our analysis of the markets, then make sure you take a look at that detailed video about the Nasdaq. Our next instrument is the euro to US dollar, and this is of course the preferred analysis, what I call the short cycle analysis, because of the 20-week cycle trough in November. That was a short 20-week cycle that preceded that trough, and the 80-day cycle trough at the beginning of this year was also a short 80-day cycle. All right, that's a short cycle over there, and we have been in a profitable trading opportunity, a C category long trade in the euro to US dollar. And let's zoom in here and take a look. We entered into this C category long trade about 2 weeks ago, or 10 days ago, here on this Friday. And of course, here was our entry price, and our T1 target was hit on the first day of being in that trade. Not an unusual thing. So we took our profit from our trade 1, and we raised the stop loss to reduce our risk. So our stop loss was over there at that point. Our T2 target was hit on Wednesday of last week, and so we exited from our trade 2 and took our full cycle profit from the trade when we exited trade 2 and raised our stop loss to the break-even level. We also started implementing the 3-bar trailing stop, and that 3-bar trailing stop, as you can see, is at this level at the moment, 1.34818. So that's our 3-bar trailing stop in the euro to US dollar. That's our C category long trade, and we will continue to adjust the stop loss according to the 3-bar trailing stop until we exit from our trade 3. The worst that can happen in our trade 3 is that we exit with a profit. I think we're sitting at about $164 profit at that 3-bar trailing stop level. What's going to happen next in the euro to US dollar? Well, of course, we are expecting a D category short trade next. Let's just go through these interactions. There is our A category interaction. Here is B, and there is C, and we're expecting D next at the level of the 20-day FLD. And so, as you can see, there is actually a trade order that has been placed already at the level of that FLD, where I will enter into a short D category trade in the euro to US dollar. Now, it is also possible that there is an alternate analysis playing out in the euro to US dollar involving longer cycles instead of the short cycles that I've mentioned. Take a look at the detailed video in which I discuss the implications of that analysis. The trading decisions are effectively the same. We would be entering into an F category short trade at the level of the 20-day FLD. The level of the FLD on that chart, because of the different analysis, is slightly different, of course. So if you believe that the euro US dollar is beating out longer cycles instead of shorter cycles at the moment, then you should be trading on the basis of that analysis. Finally, let's take a look at the British pound to US dollar. Now, last week we had our trade 3 open on our short F category trade. Here it is, which we entered right at the beginning of 2013, beginning of January. There's our F category short trade. Our T1 level was over here. We took a small profit there and reduced our risk by adjusting our stop loss. We then witnessed a G to H category interaction, and were stopped out of our trade 2 at the T2 target, somewhere over here, as discussed last week. And then, of course, we started implementing our 3-bar trailing stop. So last week on Thursday, our 3-bar trailing stop was taken out. There it was at that level over there. And so we exited from our trade 3 at that level there. So we had a really good profitable trading opportunity in the British pound to US dollar. In fact, as you can see, the British pound to US dollar has had a very profitable sequence of trades from our A category profitable trades over here. T1 and T2 and T3 over there, and our C category trading opportunity, 3 profitable trades over there as well, and then of course Christmas and New Year, during which time we didn't trade, and then our F category trading opportunity, which was also profitable. Now, in last week's video I mentioned that the next trade in the British pound to US dollar would of course be an A category long trade. Now, whenever considering entering into an A category long trade, of course, the very important thing that you have got to consider is the next interaction that I'm going to witness going to be an A category interaction, or is it going to be a G category interaction? And in the detailed video about the British pound to US dollar, which is a long video this week because there's some very important points to make, I explain how last week that question of whether an A category trade or a G category trade was going to be next could have been very clearly answered by the underlying trend, which of course at the moment in the British pound to US dollar is bearish. And there are two very important points to be made regarding that whole question. And the first is that when you have a bearish underlying trend for your longer cycles, so I'll just write here long cycles, when your long cycles are pointing downwards, the first thing that you must bear in mind is that you expect troughs to occur late. So you expect late troughs. And last week, as the market bounced up fairly quickly, it was apparent that this potential 80-day cycle trough was not a late trough. And therefore, that was the first warning that this was not going to be an A category interaction. The other thing that you must always bear in mind is that when there are long cycles pushing downwards, in other words, the long cycles are bearish, you will very often see a double GH interaction. And that is in fact exactly what we have seen in the British pound to US dollar. Here was our first GH, okay, and here of course is our second GH. Now the first GH usually occurs round about the 20-day cycle trough, which as you can see is what happened here. And the second one most often occurs round about the final 10-day cycle trough, but it can occur round about the 5-day cycle trough. So in fact these cycle troughs here might be needed to be moved over to the right hand edge. Something really interesting happened over the weekend. Of course, you know that cycles keep moving the markets over the weekend. So even though this was a double GH category interaction, if you had accidentally stopped into a long A category trade because you hadn't considered your options in terms of what else might be happening, and please make sure you take a look at the reversal trades video in module 5, which explains that in great detail, and would have made sure that you wouldn't have entered into that trade last week. Even if you had entered into that trade, your initial stop loss would have been below the low of last week Monday. So there's your initial stop loss. The market came down really hard in what was probably the final move into the 80-day cycle trough. And it's just possible that that 80-day cycle trough might have actually formed over the weekend, but of course we can't see it because there's no price data over a weekend, and price is now already bouncing out of that trough. It's too soon to tell for certain whether that is what has happened. Price might come back to the 20-day FLD, track along it a bit further, and then drop down in a final H category interaction. That is not impossible, but usually GH interactions, particularly when they are double GH interactions, are very brief. And what we saw last week was most likely the double GH interaction. And so therefore, the next trade that we are taking in the British pound to US dollar is still an A category long trade. However, because of the longer cycles pushing down, we're expecting the British pound to US dollar to come down into an 18-month cycle trough. Because of those, I am taking a very small low-risk entry into the British pound to US dollar as it approaches that A category trading opportunity. Let's wrap up this video by taking a look at the spreadsheet for this week. As you know, I color the background rows in the spreadsheet according to the status of the trade. The green colored rows are trades that I'm standing by to enter or which I have exited from completely. And the orange colored rows are trades that I have exited from, but the trading opportunity is still open to some extent, so there is at least one trade still open, and you can see that is the case with the euro to US dollar, and the open trade has a blue colored background row. And so let's first of all speak about what happened last week. Here is our euro to US dollar trade that we exited last week. As you can see, we made a $230 profit from that trade. Our long Nasdaq trades, which we were in last week, we exited for a loss. But as you can see, They were small trades, so we took a total loss of about $250, $82 on each trade. And the British pound to US dollar, our short trades, here we are over here, we exited from our trade 3 in our British pound to US dollar, and we made a profit of $576. So all in all, last week we actually made a total profit of $556. Of course, this short F category British pound to US dollar trading opportunity over here yielded a really great profit in total of $1,176. And we still have our trade 3 open here in the euro to US dollar, but you can see that the worst that will happen is that we'll exit at our 3-bar trailing stop at a level of 134.818, and we'll exit that trade with a profit of 164, which means that C category trading opportunity in the euro to US dollar has in fact yielded a total profit of $529. Of course, we might exit at the level of the 3-bar trailing stop today, or that 3-bar trailing stop might move even slightly higher, and we might end up taking more money out of the market on the basis of that C category trading opportunity. Thank you for joining me in the Hurst Trading Room today on 4th of February 2013. As always, please take a look at the detailed videos where I discuss these concepts in further detail, and particularly look at the alternate analyses and possible other trading decisions that we should be making in these markets. I look forward to seeing you next week in the Hurst Trading Room. If you have any questions or comments, please pop them into the box below this video.